welcome you to the 2016 Annual Halftime Report. We're very happy to have all of you join us on this webinar today, and we look forward to sharing our perspective on today's markets. If you'll notice, there's a small window that says questions. As I'm going through the presentation, if anything comes to mind, please type it in, and at the end of the program we will get to your questions. So without further ado, let's get started. I'm sure that you all are aware that there are some formalities of compliance. Please read through those, and then let's begin with our agenda. What we're going to do is look at the first half of the year. It's really hard to believe that half the year is already over. So far, it's been a very volatile first half with plenty of market headwinds that we will address. Our goal today is to educate you about some of the factors we and the world's market strategists are watching. Here's what we're going to be talking about. Again, a brief review of the first half, fact or fiction, 5 factors we're watching in 2016, the question, are we heading for a recession, and then finally some strategies for today's volatile markets. Here's a snapshot of the S&P performance for the first half of the year. I'm sure it's no surprise to any of you that the year got off with a rough start with fears about the economic slowdown in China combined with panic over plummeting oil prices. This caused a short but severe. You probably remember that markets experienced a correction last August, and it wasn't so surprising to see another tumble since many of the same headwinds continued to blow in 2016. Stocks regained some of their steam by the end of February, but just as investors were starting to breathe again, we had another sell-off. Well, markets freaked out over falling oil prices, global growth worries, and fears about an imminent recession. However, after reaching a low in mid-February, stocks experienced pretty steady growth until May. Then another volatile pattern set in. Markets tested new highs in mid-June and then gave in to fear as Britain voted to exit the European Union on June 23rd. Fortunately, investors shook off their nerves pretty quickly and rallied in the final trading days of the quarter. Will Brexit come back to haunt us in the months to come? Well, we'll talk about that a little bit later. All told, the S&P gained 2.69% in the first months of 2016. Though it's not stellar, it's pretty respectable considering all the headwinds markets have faced down so far this year. What are some of the 2016 forecasts and what's next? At the beginning of the year, we compiled the S&P 500 price targets of some of Wall Street's top analysts. As you can see, here are what some of them felt the S&P might look like for the entire year of 2016. If you'll now go over to the revised target, you'll see that 5 of the 10 analysts revised their projections, and all 5 revised those to a lower point. If you look at what the group average is, 2,125 for year end of the S&P 500, that makes us a little bit nervous since yesterday we closed at 2152, or 27 points higher than what the strategists have revised their group average to be. Now, facts or fictions are something that we need to look at. With all the turbulence and uncertainty, there are a lot of potential threats to watch. However, some of these threats have merit, while others are just a lot of smoke. Let's give you our fact and fiction opinions. First one, we're out of the woods with Europe. Well, on that one, we think we might give that a fiction. Between Greeks' debt worries last year, Britain's vote to exit the European Union, and Europe's general economic woes, boy, there have been a lot of headlines, and could we think that this could create some problems? Well, yes, we think that there is going to be continued volatility the rest of the year. We don't know now exactly what the later shocks of Brexit might be, but certainly the market has done very well after a short downturn. You can see in the past that some of the things that have affected the world, such as the Japanese tsunami, we had from peak to trough and back a 14-day period, but we all remember the Lehman bankruptcy. So yes, we think Greeks' debt problems and Brexit are likely to send us into more volatility throughout the rest of the year. What about the next one? And in that situation, what we're talking about is fact or fiction. Rising interest rates will spell disaster for the markets. The Federal Reserve's rising interest rates certainly have received headlines throughout the year. Will it happen? When will it happen? Boy, it was all the way to last December that first rate hike occurred. And let's kind of take a look at what's happened in the past. Again, we say this is a fiction. We don't think that any further rate hikes will bring about a bear market. We don't know for sure, of course. However, we can look at the past for a few clues. Historically, the averages show that there's an initial rise, some volatility and consolidation, and then a rally, usually a few months later. On average, history shows that stocks do pretty well in the months following a second interest rate hike. Here's what I want to take away from this. Every tightening cycle is different, and there are too many variables at play for us to say how this one will play out. Historical examples are useful to a point because it's perspective. However, we still have to prepare for things to go differently. It's that uncertainty that makes investors nervous and causes volatility. Fact or fiction? Recessions can't happen. Well, we think that one is fiction. Let's take a look at some of these indicators. Recessions are normal parts of the economic cycle. We can't be in a recovery or economic expansion forever, and it wouldn't be surprising to see a recession in the next few years. Of these 20 speedometers, you can see that City National Rockdale's predictions or projections, if you go back to the beginning of this year, saw that they were mostly green. There were 3 yellow cautions from political environment, global growth, and equity market valuations. There was only 1 red dial, and that was from geopolitical risk. But let's see what's changed since January. Here's the latest data from the end of June. You can see that though most economic indicators are still showing growth, a few things have changed since January. The political environment has shifted into red. This is likely because of concerns about the upcoming elections. Geopolitical risks are still in the red due to concerns about what might happen overseas. Corporate profits are also now a yellow caution. We'll discuss some of these risks and show you how we're preparing clients for what may lie ahead. Fact or fiction? If there is a recession, it will trigger a massive market correction. This one might be another fiction. And let's take a look. Recessions aren't always calamities. The recession that began in 2007 was especially bad for markets because of a combination of economic, business, and financial events. However, recessions don't always trigger market catastrophes. This chart shows us periods of recession as dark bars and severity of bear markets in the S&P 500 in light bars. A bear market is defined as a sustained period of market decline during which stock prices lose at least 20% of their value. I'd like to point out a couple of things on this chart. One, recessions have occurred without being accompanied by bear markets. We can see several separate occasions when this happened since 1950. Bear markets have also occurred independently of recessions. This is usually because of external market shocks. It seems logical that a recession would trigger a serious bear market. Recessions usually lead to decline in corporate profits, which ought to push stock market prices down. However, the link isn't that simple. A lot of factors influence stock prices. Factors such as inflation, interest rates, investor sentiment, and market shocks all influence stock prices. So, if a recession happens, what can we expect from the markets? This table shows us the S&P 500 performance before, during, and after an official recession. Take a look at the, I call it, second column after the recession period, where it says during recession. The first surprise is in many cases the stock market was actually up during the months the recession lasted. 9 recession periods, positive 4 times. This tells us that the link between recessions and bear markets isn't tight. So one of the many reasons why people shouldn't try and time the markets is because when you think a recession might be coming, is it really? The past can't predict the future, but we can certainly look at it for a few hints. Fact or fiction? Okay, I can go back here one. Fact or fiction? Will the upcoming presidential election have an effect on markets? Well, maybe. If you go looking, you'll find a number of theories about home price cycles, stock market cycles, zodiac cycles, all related to 4-year presidential cycles. I thought this one was pretty interesting. So basically, we think that this is mostly fiction. While the results of the presidential election might affect your heart rate, peace of mind, really the sitting president doesn't much affect markets. And then look at the rates of return of the S&P during Republican administrations and Democratic administrations. Are you surprised? While the numbers might suggest that a Democrat in the White House is overwhelmingly better for stock prices, reality isn't that cut and dried. There is no commander-in-chief of financial markets. In fact, the release of the new iPhone by Apple has a greater effect on overall S&P 500 performance than the president. Why? Apple's the largest company in the S&P 500 by market capitalization, and the iPhone is the most important product. Back in 2014, Apple and the sale of iPhone drove 18% of the S&P 500's performance that year. So, do markets perform better with a Democrat or a Republican in the White House? Well, this goes all the way back to JFK's presidency, and we'll see that the best performance was under President Gerald Ford, a Republican. However, the worst performance happened on George W. Bush's watch. So what do you think? Would you say there's a lot more going on in the stock market than who's in office? I'd say so. The big difference between a presidential candidate, what a presidential candidate says during the election, and what really makes it through the legislative process is really something to remember. What markets hate is uncertainty, and the election this year might very well cause some volatility. Depending on which party ends up controlling the White House and Congress, a lot could happen or not happen legislatively that could affect certain sectors and markets overall. We and the world's analysts will be closely watching the election to see how the results could affect our clients' portfolios, and we'll keep you informed. Now let's move on to the next point. A big question on many investors' minds is this: are we headed for recession? It's an excellent question. We're in the 7th year of an economic recovery and expansion, and we know that a recession has to come sometime. Could it come this year? Maybe, but it doesn't seem likely. Could it come within the next couple of years? That seems like a stronger possibility to us. On the next few slides, I'm going to show you some of the evidence for and against a recession so you can see the same information other strategists are watching. I love this quote. The stock market has forecast 9 of the last 5 recessions. I think Paul Samuelson has it right. But what is the definition of a recession? A recession is a significant decline in economic activity spread across the economy lasting more than a few months, normally visible in real GDP, real income, employment, industrial production, and wholesale retail sales. So it's very, very difficult to predict a recession. The government scorekeeper for recessions is the National Bureau of Economic Research, and economists there usually don't formally announce a recession until months after the recession actually begins. For example, the Great Recession that began December 2007 wasn't officially called a recession until December 2008. That's a year later and just a few months before the recession actually ended. The previous recession began March 2001 and wasn't called until November of that year. That's the same month it officially ended. Why is this? It's because all the data that goes into calculating GDP growth and other indicators isn't completely available until months later. The NBER has to be very sure of the data before it makes any kind of official assessment. So even if we enter a recession, the official call won't come until months later. We have to look at the data and we have to make some educated guesses. So in that scenario, How long do economic expansions last? Well, we've had 11 cycles since 1945. The current expansion has been going on since June of 2009. The average expansion has lasted 58.4 months, or about 4 years and 10 months. Obviously, our current expansion is well above the average. But much like bull markets, economic expansions just don't die of old age. Something has to cause a recession. And I'd like to also point out that in the last 3 economic expansions, we also blew past those normal 58.4-month ranges. Increased length of expansions, like we're experiencing now, is telling us that the economy is growing more stable. However, when we see this more stable economy and the longer it lasts than the average, this could put kind of a pro-recession mark in the column that it could be in the future. So how long might we have before the next recession hits? Well, that's the trillion-dollar question. One thing history tells us is that recessions often follow interest rate hikes. Now, we don't know that it's a cause-effect relationship because every interest rate tightening cycle is different, but we can look for clues. Deutsche Bank has collected information that indicates that the average tightening cycle lasts 22 months between the first rate hike and the last. The average time between the first rate hike and a recession is 41 months. The Federal Reserve first raised interest rates in December of 2015. Does that mean we're guaranteed to see a recession sometime in the next 30 months or so? Definitely not. The past doesn't predict the future. There are also some unique factors at play during this cycle that make forecasting difficult. One, the economic expansion has been unusually moderate and not characterized by standout growth. According to Deutsche Bank's report, out of 118 rate hikes since 1950, only 2 have happened with nominal year-over-year GDP growth below 4.5%. 2, the Fed has trillions of dollars on its balance sheet already, and that needs to be reversed, and they might be reluctant to engage in more quantitative easing if we don't see recessionary pressures. 3, we're in a complicated corporate earnings recession. The U.S. companies are already struggling with weak demand. 4th, the Fed is moving very cautiously in raising interest rates. They're looking at the same data we are and telling us over and over again that they want to move cautiously to protect economic growth. In our current rate tightening cycle, we know that the Fed is anxious to begin raising rates so that they can lower them again if necessary to fight off market shocks, economic problems, and higher inflation. With rates so close to zero, the Fed doesn't have many bullets left in the gun to fight downside risk. Another headwind for the economy is the weak state of corporate earnings. We mentioned earlier that the Federal Reserve might be taking a risk-raising interest rates while corporate profits are in recession. What this shows is the first quarter of 2015, earnings growth turned negative, meaning overall S&P 500 companies saw their profits shrink from a year earlier. Quarter 3 and Quarter 4 of 2015 were especially rocky for earnings, with the S&P earnings down about 14.5% in third quarter and 15.5% in the fourth quarter. Now for the second quarter of 2016, overall S&P earnings are forecast to be down 5.3% from a year earlier. If earnings are down, it'll be the 5th straight quarter for negative growth for the first time since the period between the third quarter of 2008 and the third quarter of 2009. Do weak profits automatically mean an economic recession is coming? No, but it's something we and other strategists are watching. Probably the biggest indicator we look at with respect to the economy is gross domestic production. This chart shows in dark blue actual GDP growth in recent quarters. In light blue stripes, it shows GDP forecasts for the rest of the year. Data are from a group of over 60 economists surveyed by the Wall Street Journal every month. Well, no surprise, we can see that GDP growth tanked in the first quarter of 2016. However, we can see that for the whole of 2015, the economy, even though we had changes in GDP, still grew at a respectable 2.4%. Clearly, the economy struggles in the first quarter of the year. Economists are still projecting solid growth for the rest of 2016. However, most of the same economists polled by the Wall Street Journal believe there is a significant downside risk to their forecasts. Over 75% believe if there is risk, it's because they've likely been too optimistic. We're now going to look at a couple of charts, and I'm going to hit the highlights of these charts. Is the labor market slowing down? Well, it might be. The good news is that even though we lost 8.8 million jobs at the bottom of the recession, we've gained nearly 15 million. Now that's good news. As of June, the headline unemployment rate stands at 4.9%. The labor market is a big supporter of economic growth. However, there are some signs that job gains might be slowing. May's job numbers were well below expectations, and the rate of annual job gains has slowed. That's to be expected given how far along the economic recovery is. Now, one thing you might see in the chart on the right is that labor force participation rate. Well, certainly we've seen that this has changed as well. Overall, it's clear that the labor market still has strength, but there might be limits to how much lower unemployment rate gets because of these structural shifts in the economy. But let's look at consumer spending. This is a very positive indicator of economic growth. And this year, certainly consumers have spent. If you look at the big ticket items, such as cars, you can see that we have certainly seen 70% economic growth and strength in this particular area. Now, we like to think that we're seeing some growth year after year, and certainly May of 2016 has seen a 2.7% positive increase of spending over May of 2015. So consumers are spending. Look at the low point in the chart showing where the recession was at, and now how we have expanded, contracted, but expanded again. So this is a positive sign that consumers still are spending at this point in the economy. The next indicator is looking at, I'm going to go back here, consumer confidence. Consumer confidence is high. Now that's good news because, again, we want to see that consumers, which are looking at a forward indicator, still are driving 2/3 of the economic growth. So in January of 2015, you can see that consumer confidence was high, and what happened? Analysts got really worried that we had too much exuberance. They hadn't seen those highs since 2007. Well, what happened? We had a choppy, flat year for stocks. Why was that? Well, it's complicated. There's not a simple cause and effect relationship between these indicators, but high levels of consumer sentiment can be a sign of an irrational investor, and prices can get bid up to unsustainable levels. Historically, recessions sometimes follow periods of high consumer sentiment. We see those recessionary periods on this chart as vertical shaded areas. But is that always the case? It certainly wasn't the case in 1977, 84, or 2004, but it did happen in 72, 2000, and 2007. All told, we'd put this data point in our positive column for the economy. So now, let's look at some of the economic positives and negatives. Predicting a recession is hard, and we won't have an official ruling on it until months after the fact. On the negative side, the economic expansion is getting old. The Federal Reserve is planning on raising interest rates. Corporate profits are weak. These trends could push us towards a recession. However, on the positive side, GDP growth is moderate and still forecast to remain so. The labor market is strong, but it might be slowing. We also have consumer spending and consumer sentiment that remain strong. These trends support continued economic growth. All told, though there are definitely some economic headwinds, the experts don't believe we're at serious risk of a recession within the next year. This chart shows the odds of a poll of Wall Street economists over the last 9 months. As you can see, economists are more worried about a recession than they were in October. On average, they put the odds of us seeing a recession at 21%. However, economists have laid odds on a recession before. Back in January of 2012, recession odds in this same survey stood at 19%, and there was no recession. What's the bottom line? We'll continue to monitor all the factors we've discussed and keep you informed. So we've reviewed the first half of the year, shared some of the indicators we're watching this year, and talked about the probability of a recession. Now let's close by talking about some strategies for dealing with volatility and down markets. There are plenty of excuses to panic. The most important strategy of all in this period is to ignore media headlines. Here are just a few of the headlines we pulled off from the last 6 months. Analyst: here comes the biggest stock market crash in a generation. U.S. stocks cleanest filthy shirt in the grotesque hamper. Boy, look at some of these headlines. But what did we learn? News outlets need headlines to pull in viewers. One of the ways they do that is by turning minor events into breaking news panics. This chart shows the S&P 500 price performance in 2004 and 14 and CNBC viewership over the same period. Do you see a correlation? Notice how viewership spiked as the stock market fell during the financial crisis. It wasn't because they were telling everyone to keep calm and carry on. People tend to focus on negative information and turn to the media in times of crisis. That's not a great way to keep your cool. Don't listen to the talking heads. Tune out the noise. Let us filter through the headlines and keep you informed. We also accept that volatility and pullbacks are normal in financial market. This chart shows the annual return of the S&P 500 since 1980 at the top of each column, rounded up or down. The red numbers below show the biggest drop in the S&P 500 experienced that same year. Some of these dips happened over days, some occurred over weeks and months. Moving along the chart, we can see something interesting. Even in positive years, stocks experience serious dips that might have made investors extremely nervous. However, history shows that these drops are typical. In fact, the S&P 500 has experienced an average intra-year decline of 14.2% since 1980. Despite those declines, annual returns were still positive in 27 out of 36 years. So what does all this tell us? Even when we see small retractments, it's not a big deal. Don't panic. Does that mean markets will always end positive after a correction? No, we'll have down years. But what we know is instead of trying to predict exactly what markets are doing, we need to step back, take a look at what analysts have to say and what the research tells us, and then make prudent decisions. We stay flexible and look for opportunities in the volatility. We focus on goals we set before we start investing. Has anything really changed in your financial picture? If we need to make prudent changes to your strategies, we will. However, we don't give in to knee-jerk reactions just because markets are moving around. This chart shows the hypothetical growth of $100,000 invested between 1996 and the end of 2015. It also shows many of the emotions an investor might feel along the way. It includes euphoria when markets are high, and surprise, nervousness, panic, and defeat when markets pull back. It's all normal and all part of being an equity investor. The investor who remained invested in this hypothetical illustration might have seen that investment grow to nearly $500,000. Investors who sold out during the lows would have missed out on all the rallies that followed. This is just a hypothetical illustration and doesn't include taxes or fees. It's not really meant to show performance of any actual investment, but it does help us see that emotions can really affect portfolios. The central tenet of investing is that we are constantly balancing risk against return. The higher return we seek, the more risk we have to be willing to accept. One of the most important things you need to do as an intelligent investor is to understand your personal attitude about risk. Risk is, unfortunately, not something we can completely do away with. Though we mostly talk about market risk, the risk that an investment's value will decrease due to market factors, there are also other kinds of risks that affect investors. Longevity risk, inflation risk, currency risk, interest rate risk, credit risk, and many more. As professionals, it's our job to help you understand how these risks affect your financial picture and help you develop an in-depth understanding of your personal comfort level with risk. If recent market gyrations are making you nervous, it might be come in and to talk to us about your portfolio. While we don't advocate making major strategy changes due to normal volatility, we do take into consideration your greater comfort and increased peace of mind. A few slides ago, we asked whether good performance meant you should dump all your money into a single investment or asset class. Of course you wouldn't. One of the reasons for that is time horizon. Along with your risk profile, we also need to understand when you expect to need the money we're investing. 3 years from now, 10 years, 20 years? By understanding how and when you'll be using your savings, we can help make sure you have the money you need when you need it. Though we can't predict what markets are going to do, we can create strategies to help mitigate the effects of volatility and market swings on your overall financial picture. The money you'll need in the next 1 to 3 years, we'll look at investments that are highly liquid and very stable in value. The longer your time horizon, the more prudent risk we can take with your portfolio. While you might say to yourself you don't want to take any risks, even with your long-term money, there's always one risk you can't outrun: inflation. Can you really afford to let your money sit there with inflation eating away at it each year? Though inflation has been low in recent years, historically inflation averages about 3% each year. With Americans living longer than ever, it's very important to have enough growth potential to be able to fight rising costs for the next 20 or even 30 years. Our goal with this strategy is to identify your short, medium, and long-term needs. And how do we do that? Well, we're certainly going to stay active in uncertain markets. Once your portfolio has been constructed, that doesn't mean the hard work is over. We continuously monitor markets, performance, current trends, how to stay on top of what's going on. While we believe it's prudent to have a core of passive investments or strategic, we also think that we have to have good investments that can engage in the markets, active strategists that rely on analytical research, forecasts, and their own judgments and experience when making investment decisions, or more of a strategic rather than just buy, hold, rebalance, and sell. Now, an active strategy can eliminate the risk of fluctuating prices and uncertain returns. It can ensure a profit or guarantee against loss, but it does help us be responsive to changing market environments. So I want to close with this. There are a lot of financial and economic uncertainties in today's world. While we often can't predict or prevent them, we can mitigate them by being prepared in advance. Here are some of the top fears cited by retirees in a recent survey. 44% worry about future health care expense. 44% worry about reductions in Social Security benefits. 41% worry about outliving their savings and investments. How prepared are retirees for retirement? While 54% have financial strategies for retirement, just 10% have full underwriting. Only 7% have prepared in advance for saving shortfalls or retiring sooner than expected. 12% wish that they had gotten financial advice sooner. It's normal to be worried about the future. It's normal to wonder what retiring in volatile markets will be like. Well, we can't control markets and we can't predict the future. However, what we can do is study the data, test different scenarios, and create strategies to help you pursue your retirement goals in many different market environments. We want to thank you for tuning in, being a part of this webinar today. Again, if there are any questions, we ask that you go ahead and type those in. We'd also like to remind you that if you have a friend or relative that you think would benefit from this type of information, please contact them, and with their permission, we'll add them to our economic updates and we'll get acquainted. We want to thank you again for joining Swofford Financial on this halftime webinar. We want you to make it a great day. Thank you.